Good morning or afternoon. Welcome to today's multifamily webinar, Navigating the Multifamily Market. My name is Rob Britt, Senior Vice President of Multifamily Housing at Zonda, and I'm excited to kick off this session. Our presenter has a ton of great analysis to present, and it's a very critical time for the market, obviously. Today's webinar is proudly sponsored by BetterBot. BetterBot is a leading AI platform provider in the multifamily industry. They're also a partner in our media and events group. Their technology delivers efficiency across marketing, operations, and on-site teams, enabling owners and operators to navigate economic challenges with confidence, keep properties full, and ultimately increase profits. BetterBot enhances responsiveness, maximizes occupancy rates, and improves prospect and resident experiences, all while providing transparent reporting for greater visibility. In a time when our industry faces tighter budgets, staffing challenges, and economic fluctuations, BetterBot stands out as a trusted partner. They are proud to serve 12 of the top 20 property management companies as recognized by the National Multifamily Housing Council. BetterBot's true AI technology enables a seamless human experience, helping people find homes they love and helping properties achieve the profitability they need with fewer resources and greater efficiency. Please take a moment to connect with BetterBot by using the QR code displayed on your screen. This will provide you with more information on how BetterBot can be your partner in innovation, savings, and growth. And you can also check the boxes at the end survey and to get more information from our partners. So with that, let's move on. I just have a couple of product announcements I'd like to make. We have our rental housing outlook, which is a product focused on the rental side of the marketplace. And our expert advisors craft reports and analysis for published research. Rental Housing Outlook is published research subscription that offers insights and trends on the rapidly growing rental housing industry. Learn more and get a sample report at zondahome.com/rental-housing. We're also thrilled to announce the upcoming launch of Enterprise with Build to Rent this fall. This add-on to Zonda Enterprise will give you the power to dive deeper into the build to rent market, providing you with the most accurate, detailed, and up-to-date data available. Enterprise with Build to Rent will allow you to track key indicators such as current inventory, future supply and timing, market depth and demand, product styles, rates, and much more. So don't miss your chance to be at the forefront of this evolving market. Speak with an expert or join the wait list by simply filling the form out at the end of the webinar. And finally, I just want to give a plug and shout out to Zonda Advisory. Beyond our presenter here today, we have a full team of experts that cover master plans, multifamily, build to rent, and consumer research. Our team of advisors has decades of experience across the entire spectrum of real estate, helping you assess the market, strategize, and grow your business. So with that, it is my pleasure to kick things off here and introduce Kimberly Byrum. She is a
Thank you, Rob.
I was going to give you a little bit of an intro, Kimberly.
Okay.
But she leverages her deep knowledge of market trends, data analytics, and strategic insights to guide some of the nation's leading multifamily firms. She's known for her ability to translate complex data into actionable strategies that drive growth and success. And today she's going to be sharing her expertise with us, offering valuable perspectives on the multifamily housing market and what we can expect in the months ahead. She has a great presentation that I got a sneak peek at yesterday. Please join me in welcoming Kimberly.
Thank you, Rob. I appreciate you always partnering with me on this multi-phased webinar. So I want to jump right into our roadmap. We have a lot of data that I want to cover today and wanted to share kind of a funny story. I think it's timely that we'll be talking about macroeconomics this week, since that is on everyone's mind as the unemployment rates came out. So we're going to talk about that and some of the factors that we're watching. I want to kind of jump into how our renters are feeling and the data that we're seeing that's coming out of our renter profiles. From a multifamily fundamental standpoint, I'm going to give you our modeling projections on where we see the market headed in the near term, certainly through 2026. Talk about our most active markets, and those are markets that we are underwriting deals in currently and continue to monitor on an ongoing basis. And then finally, share a little bit of knowledge on a newer product type that has entered the market, and that is attainable housing, and some of the performance metrics that we're seeing out of the class of 2024 lease-ups. And finally, just finish up with some closing remarks. So macroeconomics. Want to jump in really quick. I am a voracious reader and love to find new books and new content. I also spend a lot of time on LinkedIn Learning and Masterclass, and I came across an article in the Harvard Business Review this issue, so July issue, that talks about this book, and it is just so timely in terms of what the limitations of modeling are based on our recent experiences with COVID. And some of the key takeaways from this book are let go of our master model mentality. As a business leader, we need to stop relying 100% on models because they do have very, very large variances currently. Discount that doom mongering, those clicks that we get on a daily basis, and help us just understand that macroeconomics is not physics and there is no precise instrument that helps our business leaders to make strategic decisions. So overall, its recommendations are very simply look at everything and use your professional judgment, which we all have the ability to do. So my goal today is to provide you with the facts and help you kind of navigate through that and talk about some of the opportunities. But this chart, I think, is very eye-opening because it shows you in the baby blue lines is the 70-year range of these different key economic metrics that we like to watch and the variation that those metrics experienced during the COVID low and the COVID high. So you can see how that would wreak havoc on econometric models when you have such variation during a short 3 to 4 period time. So the elephant in the room is the news that we got last week on the unemployment rate for July. And the answer was 4.3%. So we increased our unemployment rate from 4.1 to 4.3. So kind of in a vacuum, that triggered a lot of discussion about the SOM rule, which is a simplistic measurement of unemployment. And it basically takes the 3-month moving average of the employment rate over the last 12 months, and you're looking for the lowest point during that last 12 months and measuring it against the 3-month average as of today. And if we see a variation of 50 basis points, the conclusion is that we are either currently in a recession or there is a recession that is imminent. And so the talk this week went from soft landing back to a 25 to 30% probability that the U.S. economy will go into a recession. We're continuing to watch this. This is obviously one metric, but it's out there and it's prevalent and it's being discussed. So that flows right into what is the Federal Reserve going to do next? Prior to this data being released, I think there was talk, and that comment was right after the July 2024 meeting, where Chairman Powell said a rate cut is on the table for September, albeit if the totality of data cooperates. And again, not looking at one metric, but the totality of the data. This is an interesting CME Fed watching tool. I like to peer at it occasionally to see what the predictions are for rate changes. And as you see here, I'm showing you 3 points in time. In May, we were looking like in the September timeframe that we would see there's a 66% probability that Feds may lower the federal funds rate, with it stair-stepping up through the December meeting. Through the summer, same kind of mentality. That's what people were thinking. After the July numbers came out, I pulled these numbers again, and it's 100%. So there is a lot of anticipation that the Fed will meet in September and will lower that federal funds rate. From a commercial real estate side, this is data hot off the press from the Board of Governors of the Federal Reserve System, and it is their quarterly survey of senior loan officers. The chart illustrates net percent domestic respondents. The royal blue line is the respondents saying that they are seeing standards for CRE loans tightening, and the green line is the demand for CRE loans, and these are specifically multifamily loans. So as you can see, in the second quarter of 2023, we saw a very low demand for multifamily loans, and we saw a very high sentiment of tightening of standards, and that remained that way really throughout the totality of 2023. As we've come into 2024, we've started to see the sentiment loosening, and I use that word very lightly, or a modest decline in tightening standards. As it sits as of July, those respondents are getting closer together, the demand and the tightening standards, but we are not near where we were, and I'm showing 4Q of 2019 as that pre-COVID time period before we saw so much volatility in the marketplace. So I would conclude that credit is still somewhat difficult, and the demand, while rising, is still rather low. Depending on what data point you look at, transactions are down. They're down on volume, they're down on numbers for 2024. On a cap rate, so where are cap rates? The national data providers are suggesting that we've seen an inflection point in cap rates, and that those are up in the low fives. You read a lot of information on LinkedIn, a lot of different opinions on cap rates remaining around that 5% range. Transaction-wise, we just haven't seen much to help us with price discovery. However, there have been several, in fact, large portfolio transactions that have occurred this year. Interestingly, at the beginning of 2024, I started a little list of notes in my phone. And what I would do if I was at a conference, or if I was listening to an interview or reading information, I would write down little notes and little snippets of things that I would hear about commercial real estate. And my number one note says, Blackstone, more activity. That is exactly what they have proven out this year. They've acquired, they've sold, and they're definitely in the market today. I think the implied cap rate, there's a lot of information spinning around on what the implied cap rate was on the Quatera portfolio. I think it's somewhere in the mid fours, high fours. But all that is, out there and swimming around in the market, and we're really still at a point where we're trying to find some price discoveries. So switching over into the renter space, I want to talk about how they're feeling. And so first off, I wanted to look at wages. And so this is the Employment Cost Index from the Bureau of Labor Statistics. And what it is illustrating is total employee compensation. And if you're an employer, this is good news because those numbers are coming down. But if you're an employee, it's also good news because they still remain rather high compared to history. So overall, our wages are still good. But how does that translate into our inflation-adjusted wages? So that's my next slide, where I'm illustrating real wage changes. This is inflation-adjusted wages. And what this is showing us is that we've got a really nice 12-month time period where, as the Fed has been fighting the inflation numbers and bringing that inflation rate down, we are starting to see true growth in our wages, albeit pretty low, under 2%. And I'm still jokingly waiting for my $8 coffee to come back down to $4. But overall, we are seeing in the numbers a positive increase in wages. So what does that mean for a renter? Well, it's influencing their consumption. It's influencing their savings account and their investment account and just their overall feelings of stability about the economy. So that's where I love to switch over into one of my favorite charts. And if you've been a participant in this webinar before, you've seen this information. This is the Conference Board's Consumer Confidence Index. And the dark blue line is how I feel about right now. And the light blue line is how I feel about my prospects for the future. So as you can see, it's a very volatile measurement, of course, but the dark blue line has been declining. pretty much since the beginning of 2024. So as we've gotten more information and as we've progressed through the summer, we see that how I feel about right now is starting to decline. And I think that that is really a worried about the higher cost of living, although we've seen that real wages are in fact increasing, just slightly. Of course, higher borrowing costs and impacting homeownership rates, and I'll share that with you in a minute. And just, the weaker potential job prospects for the future. And so that's just weighing on our residents' minds currently. If you ask them about the future, you look at that blue line, you see that again, also very volatile, but ticking up. So feeling a little bit better about what may happen in the future, but certainly a little cautious about how we feel today. And I know we spend so much time poring over every word that the Federal Reserve Chair says. And right after that meeting, I think importantly, he said, I would not like to see material further cooling in the labor markets. And that is exactly what we have seen, certainly with that unemployment rate. But if you're a renter, again, you are looking at where I've been has been pretty good, but where I think we're headed in the near term for sure, I'm starting to see, some signs of change. I love this chart. I go back to 2002 here because I want to give a broad perspective about where we've been. And most importantly, I love to look at 2011 to 2019 as that macro stable economic period. And you see here, we were at about a run rate of job growth during that time in the US of 1.6% on average, topped a little over 2 in 14 and 15, but overall kind of bumping around a little over 1.5%. So you can see, obviously, in 2019, we were kind of ending the year before COVID began, wondering back at that time where the markets might go. And of course, COVID hit and we had this big drop and this big swing back up. And as we come off of 2013, the cooling of the economy that is intentional by the Fed is really taking hold. By the way, those forecast numbers there at the end are a consensus of 10 different national economic forecasters. And if you read a lot of data, what they'll say is it's better to combine many forecasts, and those are more accurate than just taking one. So FYI there. But overall, those are important too, because those are driving my models as I'm projecting out in the future, is this stair step down of growth. Again, where am I at if I'm a renter? Well, I'm definitely reading those headlines about declining home ownership rates. And these are the top markets that have declined over the last 10 years, according to the American Community Survey. And you'll see Miami tops this list. Interestingly, 2 days ago, Ali Wolf, our chief economist, released our quarterly lot sales index. And what caught my eye was that she mentioned that Miami is the tightest single family lot market in the country. Well, that's definitely playing out, and that not enough product is coming to market there from a for sale housing standpoint. And we're definitely seeing a decline in home ownership. Surprises to me, Dallas, Fort Worth, where we do build a lot of housing. There is still somewhat of a housing shortage per some of our Zonda data, but overall we've seen home ownership decline in the Dallas-Fort Worth Metroplex as well, and Houston and San Antonio, some of those places where we consider more affordable housing markets. And then finally, as a renter, this is good news, because we've seen this wave of supply coming with, it's kind of little cat ears. We had one wave hit us in the second quarter of this year, so we're working through that now. We're going to see another wave in 10 months around the second quarter of 2025. So during that time period, if you're a renter, there's a potential that you're not going to see large rent increases. And of course, you've sustained some over the last few years, so that's good news. So when you're looking at everything that's presented in front of you, I think this is very positive as a renter, is to see that this pipeline is going to really mute the opportunity to see these large rent increases. So what are we seeing in the market today? And I'm quoting here from a great Multifamily Executive Magazine article that was released this week that reviewed all of the second quarter recalls. If you haven't had a chance to read that, go take a look if you don't have the time to go through every one of those transcripts. But as one of the main points of the article was how the REITs are reporting some of their lowest levels of resident move-outs for those looking to buy homes. And that it's really just kind of stopped flat. Earlier on the homeownership slide, I had a quote from Rick Campo that talked about in the markets that they're the most active in, it's about 60% more expensive on a monthly basis to own a home than it is to rent an apartment. So we're seeing that certainly in the data. I think there's a couple things going on here. I think that renters are, again, you look at that consumer confidence and they're saying, gosh, I'm okay, I have a job, my wages are starting to improve, but I'm not going to make any big moves right now. And certainly I'm not going to go and move out and into take on a larger payment. So here we're still seeing really strong renewal activity, and that is something that played through in the REIT calls. Just as an FYI, going back to the GFC during a period of severe job loss, I went back and looked at renewal activity during that time, and as demand eroded, we saw renewals drop to 47% nationally. So that could be maybe your baseline of, hey, if things get really bad, we are going to see people moving in with roommates, things like that. So there will be fewer opportunities for renewals, which also impacts our ability to have strong rent increases. Finally, I want to share this chart. I shared it in my webinar last time, and I've really been talking a lot about this with clients lately. But this is the age of the renter population in 2023. And there's just so much to unpack here. I want to spend some time for a minute here. But first, I want to draw your attention to the first-time home buyer cohort. That average age of a first-time home buyer per NAHB currently is 35 years old. So if you look at that, that's kind of where I break up the millennials. I call them the older millennials that are 35 and older in the green cohort, and then the younger millennials, which are 34 down to 26. And what's really interesting here is if you look at the overall millennial population, you see that 50% of them are renters. But if you break it down into the older and the newer, you see that the younger population is actually renting at almost 60%, and then the older population is at 50% of the millennials. So you see there's a really divergence there in the data. So that's one thing. Another thing that's really important on this slide is that line. And that line is at 4 million people per age cohort. What that's telling me is we have a runway of about 15 years of that sweet spot renter aged population that will be coming through our system that are going to need housing. This is a great opportunity for our industry to look at product diversification, to look at offerings, to look at markets, and to understand and meet the needs of this generation of renters that are coming. I've got a couple of gray boxes here I want to point out. So those younger millennials and those older Gen Xers and younger boomers, I have those in gray boxes because to me, that BTR product that we're bringing to market is very interesting. And again, over 4 million in those cohorts. So a lot of opportunity there to meet the needs of those populations, those that are either can't buy a home but want that space, or the Gen X and young boomer population that want to downsize, kids are moving out, don't need the space. And that's an opportunity there. And then finally, that last box is the silver tsunami. And you hear a lot about that, but the average age of an active adult community is 72 years old right now. So if you look at what's coming, not as much as 4 million yet, but over 3.2 million each year also coming into that space. So there's an opportunity there to meet the needs of the boomers that may also be moving out of their homes, want the lock and leave lifestyle, want the renter lifestyle. So there's just a continuum all along this demographic profile for us to meet the needs of the different cohorts at a product that they want. So I'm going to switch into multifamily fundamentals and talk about that national outlook. So again, going back to 2001, I'm showing you U.S. occupancy, and you can see other than the peak or the bottom of the great financial crisis or the peak of it, in 2009, occupancy fell below that 93% range into 92.1. So that was severe job loss, pipeline, and just the perfect storm. So in that, again, kind of there's the floor for where the market could go if the bottom fell out of the economy. So 92.1. Going forward, you can see during that period of macro stability, 2011 to 2020, kind of ratcheting up as we weren't building very much. We were just kind of building to replace. And you see occupancy going up above 94 and a half there in 2019, a little drop in 20 during COVID when everything kind of stalled. And then that unprecedented occupancy number that was reported in 2021 that really kind of set off rent growth out of control and a lot of other things. And then, of course, coming back to normal. So end of 2023, kind of back to par, 94.2. And of course, a lot of that pipeline coming into the market. And we are anticipating with the pipeline and the job growth, the modest job growth that we're expecting over the next 3 years for occupancy to fall back into that low 93% range. Again, a lot to unpack there, but I also want to point out 2027 is not on here for a reason. It's just so hard right now for us to determine where the pipeline is going to be, because we know there are not a lot of starts, and I'll show that in a minute. But it's just really like a phantom supply number. We don't know what's really going to hit the market there. So if the jobs come back and we don't have the pipeline, we could have another bounce back situation that could also create some more rent growth spikes. So talking about rent growth, the historical rent growth at the US level going back to 2002, and this is asking rent. So you can see here again, during the depths of 2009, rents at a national level. Now that's not geographic. We could get into geography, and there would definitely be differences. But in 2009, a drop of 2.5% in rent growth, again driven a lot by the job loss, and then digging right out of that hole and going all the way up to 6.1. Again, that was, to remind you, that was when there were some really strong job growth years, and then kind of normalizing back into that mid 3% range. 2020, not a lot of rent growth, and then of course that spike driven by occupancy and renewal activity and everything going so high and then dropping back down. So one point I want to make here, anytime I'm looking at rent growth right now, it tells me nothing to look at year over year, because everything's going to be down compared to where we've been. So I'm really focused more on year to date numbers and looking at, how are we doing through the year? What are we seeing? What kind of indicators are we seeing market by market? And there's a lot of different data points going around and swimming around out there that we need to interpret. But I definitely want to look at year to date rather than that year over year. Going forward, our models, again, we talked about how hard models are right now. We are expecting a little rent drop in 2025 and then an improvement in 2026. And again, this is at the national level trending. Of course, again, I wanted to talk about starts. This is a 3-month moving average of construction starts of units in buildings of 5 plus. So you can see here, very volatile, very up and down. You can see the trend upwards from the start of COVID, or kind of the middle of COVID, that trend upwards, and then a complete drop as of June 2024 from the peak. You can see that is a 43% decline in construction start activity. So somewhere it fell a little bit below 300,000 units in I want to say March or April, and it's bumped back up a little bit, but it's again very volatile data. An important point here too. So typically, if we have 500,000 units under construction, we historically would be delivering about half of that in a year. During COVID, those numbers dropped down into the 30s. So a lot of what we're seeing on this pipeline coming through the system is just delayed product that was under construction that should have delivered during that 97% occupancy time period, but just was delayed because of slippage. So it was kind of this timing issue, so to speak. It wasn't that we started building a lot more. It was just that the timing of it all happened at the same time. So jumping into the markets, and this is a summary of all the markets that Zonda is actively working with clients. It comes out to about 40 markets that we are actively underwriting deals in. So I spend a lot of time looking at job growth, and because that is such a immediate measurement of growth in a market. And so I've got these major metro areas in three buckets. And these metros that I'm sharing with you currently are the strongest. And this is year over year job creation, 2024. And you can see here, Miami again, circling that, going back to the home ownership issues, renterships, et cetera. Miami and Fort Lauderdale, very strong growth and very low unemployment rates currently. So to me, maybe we're kind of at the peak there in terms of where we can go, because we're kind of running out of workers unless we've got a bunch of people migrating from the Florida Gulf Coast over to Miami, and we'll talk about that in a minute. But overall, very, very tight markets in terms of labor. I circle Raleigh because Raleigh's got some pipeline coming through the system, but very strong growth currently in the market and some opportunity to continue that growth. Sacramento always pops up as one of those stronger markets in California. And then Houston marches to a beat of its own drum, high unemployment rate currently, but also strong year-over-year growth. And we have Austin and San Antonio rounding out the Texas markets that fall into this still what we're calling pretty strong job growth. Jumping into the second bucket of markets, these are the most popular markets, and this is where most of our clients are looking at deals or are delivering deals currently. And these markets are all sustaining job growth between 1 and 2%. And again, want to watch these because of the pipeline in these markets, we want to make sure that the market health remains strong. But overall, you've got Dallas and Fort Worth, Charlotte, Orlando, Phoenix, and I'm going to talk a little bit more about Phoenix because very strong growth, a little over 1.6% year over year, 3.5% unemployment rate, so the ability to grow somewhat. And you cannot stop at the headline of Phoenix, and I'm going to show you why in a minute. But Phoenix is one of those that I'm also circling. Look at Tampa. I want to talk a little bit about Tampa in the future. Tampa was one of those pandemic popular markets. So very, very strong growth, coming off strong growth numbers, but I'm definitely seeing a change in the momentum in Tampa and then the other Florida Gulf Coast markets. Slowing activity, no surprise. The tech industry prior to all the AI meeting the market, storming the market, we were seeing a recession. We were talking about a recession. These are also some of the metros that lost during the pandemic. So definitely below that 1% job growth. Maybe many of them are working in those 1 to 2% markets like a Raleigh, and higher unemployment rate. Nashville is interesting. It's actually at zero growth right now, year over year. And this is, by the way, this is the current population survey. I was talking with one of my colleagues and he said, maybe if we look at Nashville, the household survey, we would see some growth. But that's one, they do have a very tight unemployment rate there. So that could be hindering their ability to create more jobs. But that one kind of falls as an outlier in my mind, as a market that you would expect to continue to see job growth. And then finally, I do have clients that dabble in some of the secondaries. So I wanted to give just an overview of what we're seeing on the job front side in these markets. So Boise was definitely a pandemic popular kid and continues to see very strong job growth. And again, a lot of slack there on the unemployment rate to continue that growth. Oklahoma City is kind of Sacramento of the South and continues to always hit those numbers. There is an oil influence. There is a military influence. So a lot going on there. I have Omaha on this chart because I've done work there, but I also went to the College World Series this summer. Sadly, I am an Aggie, but it was a great experience. And so also a pretty strong growth market, over 1.6%. And again, I'm circling Sarasota and Fort Myers, putting that in the same bucket as what I'm seeing in Tampa. All of those were very popular and are seeing some drop in momentum and some slower growth ahead. So how are we doing on absorption? This is a very simple measurement, but it's basically the number of units delivered divided by the amount of units absorbed, or absorption, supply to absorption. And so a measurement of 100% or 1.0 means that everything I delivered, I absorbed. And you can see the majority of the markets at least absorb what they delivered. And in fact, some of those supply constrained markets delivered vacancy that was already in the market. So in Riverside, Oklahoma City, some of those places, you're seeing them actually improve their occupancy based on their absorption. And then there are those that are below one. And again, talking about those job numbers, San Diego, kind of an outlier there, but Fort Myers, Tampa, Sarasota are the ones that I kind of circle because we are watching the demand outlook. And of course, Denver having that tech influence, also having some issues with their pipeline and absorbing. So year to date, by the numbers, you can see Dallas, all the large metropolitan areas that have a lot of pipeline coming on, by the numbers, are registering the most demand. So I want to jump into, I'm going to drill down a little bit on Dallas, Austin, and Phoenix and share some submarket data with you. So how is Dallas doing overall? So I actually went in and studied all of the lease ups year to date. So if they began lease up in January or were in some form of lease up through the middle of the year, and calculated by submarket what the average pace was. And so you can see a wide variety of performance in Dallas, from Frisco at 18 move-ins a month all the way down to Ellis County, which is a very rural county with communities just very sporadically being added, and certainly probably roads still being added to some of those communities on the lower end of the absorption cycle. But overall, you can see that blue line, which is concessions, bumping up around 8%. And again, 8% is 1 month free. We have a couple markets bumping up to the 12% range, but for the most part, kind of around that 8 to 10% mark. There's some asterisks by some of these submarkets. Those submarkets also have BTR leasing up, and quite a bit of BTR in their lease up period. And I point this out because typically, if you participated at our BTR event in January, I shared the absorption pace of BTR compared to Garden, Tower, Podium, etc. And last year we saw Garden do about 19 move-ins a month, whereas BTR, depending on what type it is, goes from 11 down to 9 or even 6 if you're a single family detached. So those markets that have more BTR in them are seeing overall rates come down somewhat. Switching over into Austin, probably the biggest takeaway here is every submarket has a lot of supply, and there seems to not be a lot of variation in the performance. Round Rock and Georgetown, from a suburban market standpoint, outperforming the rest of the peers somewhat. Probably most importantly, you're definitely seeing that concession line all above 10%. Downtown does not have a lot of new units, and most of it is tower, and surprisingly doing rather well. Typically, you see tower absorb at a pace of about 14 to 16. So that's pretty strong. It's not all tower, but some of it. So overall, again, some BTR, not as much influence there, but overall, an elevated concession in Austin, which isn't surprising. And finally, and this was Phoenix, and I brought this to your attention earlier because I want to make sure that I drive this point home. But ultimately, in Phoenix, you cannot stop at the market level. You must drill down. And you see here, overall, we see concessions above 10, and we do see a variation in the submarkets. Certainly, Central Phoenix doing 17 a month, all the way down to 9 in Pinal County. But what is most important, and what I did was I pulled back 48% of the properties currently in lease up in Phoenix are BTR. I've already mentioned that they move in at a much slower pace. There's a lot of reasons for that, the way that they deliver units, the way that they may not have a centralized leasing. There's a lot of different things going on there. But if you peel away the BTR from this data, look at the difference in performance here in these submarkets. In East Mesa, if you look at the overall lease ups, that number is 15. But if you look just at the Garden, it's 20 units per month. So really big variance there. Overall, 4 move-ins per month in these markets. So this is very important. You cannot stop at that market level in Phoenix. This is all of I did the same thing on the top markets to show you. Biggest takeaways here. The ones in yellow, I think that one of the things influencing these lease-up paces is there's very strong renewal rate activity in these markets, and that is definitely slowing the lease-up pace at new properties. Places like Charlotte, though, and Atlanta, a lot of that new product is out in the outer exurbs. And they, again, I mentioned this earlier, they may not have all the roads to the community yet. So I think that they're struggling somewhat locationally to get absorption to happen out in some of those areas. I point out Nashville, and Nashville's one where the data is kind of back and forth, and I'm just scratching my head about a lot of things that I'm seeing out of Nashville. Raleigh, I'd like to see it doing better. It's got strong job numbers, but again, also really strong renewals. So I'd like to see that one raise up a little bit. Running close on time, so I want to get through a lot of this, but the stabilized. So then I begin to ask myself, are we running into a situation where our lease-ups that are offering these concessions, is it bleeding back into our stabilized properties? And so what I did here was I'm looking at 2000, again, that depths of the GFC, that 2009 time period. And I'm looking at that blue line is total market, and I'm looking at the chart on the left-hand side of your screen, by the way. So blue line is total market, green line is the next newest market or product in the market, so maybe the A- properties, and then the yellow line is the newest delivered into the market. So you can see during the GFC, all product type was offering the same percentage of units with concessions. And if you also look at the concessions on the right-hand side, they were all offering they were matching each other's concessions in essence. If you look at today, you see there is definitely a difference. The market compared to the newest stuff, there is a delta. Less than 20% are offering concessions in the total market. And by the way, this is the aggregation of all the markets that I just presented. And then you see the A+ product is almost 30%. So there's definitely a variation also in the amount of concessions. So overall, I'm concluding that we are not seeing the stabilized properties having to offer and match all of the concessions that we're seeing in the newest lease-ups. And this is something to continue to watch, because that will definitely be an indicator, going back to the GFC, that the markets are challenged. Again, this is kind of the Captain Obvious slide. Where are the markets offering the highest concessions? And so I'm not going to spend a lot of time here. We all know where those are. Year over year versus that year to date. Again, I want to talk quickly about this, but 55% of the markets are reporting negative year over year rent growth. And again, if you go back and look at where we were, of course, we're going to be down from that. But if you look at year to date, it is somewhat of a different story. Almost 90% of the markets are somewhat positive, although I kind of put that one tranche that are below 1% in the probably sampling error. So they very well could be in some kind of negative rent territory. And obviously Fort Myers, we've already talked about those Florida Gulf Coast markets, and Austin, where we know that there's pipeline issues. So you can see all the way down, makes a lot of sense. And then you've got some markets again that are doing well. And I circle Nashville because it's just making me scratch my head, because we are still seeing year-to-date rent growth. That could change. A lot of their factors, that, as you recall, as I pointed out through this presentation, have been up and down and up and down. So something to watch there. Again, I presented this last time, but wanted to show it again. And this is the overall impact of renewals. Renewals have been very strong, and I pointed this out earlier in some of these markets. But if you take a look at, these are just the markets that have year-over-year effective rent change that's negative. And I calculated their blended rent change, so taking into account their lease trade out. And what you see is that many of these markets are actually a little to the positive, and some of them greatly to the positive when you take into account Fort Lauderdale, for instance, that has a 55% renewal retention rate currently. Very strong numbers. So you can see how that would impact your rent roll. So finally, want to finish. We've spent a lot of time with clients talking about diversification. And one of the greatest new product lines that has been coming to market is what we call this attainable housing. And this is housing that is built targeting incomes between 80 and 120 of area median. It is non-subsidized housing. It's market driven. The rents are market driven, and they are different and vary by each market and by product that's being offered. The target market for this housing is essential workers, so teachers, nurses, firefighters. Attainable housing is a benefit to the community in that it can alleviate housing pressure without devaluing our neighborhoods. And then overall, we are seeing the product be a little bit different. Sometimes you see smaller studios or efficiencies, definitely limited differentiation. You don't see 50 floor plans, you see like 3 to 5 at the most. And the way that attainable housing is being developed is with cost savings in mind. So a lot of these mature builders are getting into this marketplace with the knowledge that they have on how to make things efficient and are doing site selection based on cost criteria, having efficient design, minimal but attractive landscaping. And while the interiors seem to mimic somewhat luxury, they're really intended to be durable. So things like plank flooring, granite countertops, side-by-side washers and dryers, which you would see in a suburban product, and stainless steel-like appliances. So some of the product type variations. So I want to quickly share, this is the class of 2024 Attainable Housing Scorecard. And what we're seeing, I identified within those markets that we're active in approximately 12,000 units that are currently in lease up that are within this attainable housing model. I'm also seeing about 1,700 more that we'll be delivering into the market in the next 6 months. How are they doing? They're absorbing at the top of the class currently, doing 18 units a month. And as you recall, that was when you're looking at the different markets and certainly the different submarkets, you're seeing 18 was on the high end. So on average, this product type's doing about 18 a month. Lease up concessions, yes. Actually having to match the market for the most part on lease up concessions. Again, it is a market rate product, so you've got to understand the markets there. The average project size is somewhat bigger. If you look at the class of 2023 garden deliveries, the average unit size was about 290 units. So a little smaller, a little larger than an average garden style that has delivered recently. And again, that makes sense from a cost saving standpoint. You need to be able to spread your costs over more units. And then finally, average monthly rents about $1,600, about $1,575, or dollars, almost $1.70 per square foot on 934 square feet. And I want to circle this real quick because you got a couple of different models out there. You have some that are just really doing a standard suburban 1, 2, and 3 percentage 60, 40, 10 kind of model with that anywhere from 950 to 1,000 average square footage. And then you have other groups that are targeting more of the monthly check rate and keeping the units small. So you will see some higher rents per square foot on those that may even be above what's in the market currently. So as you're underwriting that, it's not always just, oh gosh, attainable housing is cheaper than all the comps in the market. It's probably just about the same and maybe a little more because it's newer, but it could very well be within those same limitations. So where are we seeing a lot of the distribution? Again, this is class of 2024, and you can see Houston has been the largest market receiving, and again, very large market, many small submarket areas in the north and in the south that have been growing, and so seeing a lot of product out there. Phoenix, of course, and then Dallas, Charlotte, Atlanta, and San Antonio. Not seeing as much in Austin, and I'm sure the developers are just avoiding Austin currently because of the pipeline. And we're starting to see the product type pop up in some of the Florida and Carolina markets. So overall, some of the top brands to be looking for if you're out in the market and you want to shop it. Pros is a brand by Alliance. They probably have the most in the market at this point. Allura by Trammell Crow is probably second. And then Quaterra has developed a brand called Emblem. Mill Creek has a couple of projects announced called Beckett. Cabana has been in the Phoenix market for quite a while and has several projects, and not just delivered this year, but a few years ago by Greenlights. And then Wood Partners recently announced a project in Georgia and a project in Florida to be coming in the next 2 years with the brand Altera. So overall, a really interesting product type that is, taking the market, I wouldn't say by storm, but certainly is creeping up into the market and can be a great way to solve problems for affordable housing and for those essential workers. So finally, closing thoughts. I'm taking my own advice. And so I actually put together a SWOT analysis. And so looking at the strengths, weaknesses, opportunities, and threats that we're seeing in the market currently, as I've already reiterated, the absorption, the jobs are still holding, wages are looking good for our renters, and we've heard this a lot from the REITs, et cetera, the propensity to rent is going to remain high as home ownership becomes out of reach for many. The weaknesses, I'm worried about the Gulf Coast of Florida. I'm wondering if they're all going to move to Miami because that's where the opportunity is. But there's definitely, some things I want to keep my eye on there. Transactions, we'd like to see more of them. Price discovery is not there yet. Credit conditions are still modest easing of lending standards, but are below pre-pandemic. Some of the threats that I see: demand erosion. If a recession does come to fruition, all bets are off, and we will have a hard time in 2025 and potentially 2026, leading to a bigger decrease than we are projecting in rents. This higher for longer notion: the central bank has been so patient, and very, in some people's opinions, slow to respond, and waiting for these incremental data points. So just waiting for another card to flip, another card to flip. So I think the anticipation of this September meeting will really maybe add some more clarity, or keep us wondering. Watching those concessions, they are out there on lease-ups. Want to make sure that they are not bleeding over into our stabilized. Want to finish on opportunities. Again, we see pre-developments. With that delivering into the gap mentality, starting pre-development now in just about any market would get you into that gap. Demographics, very, very strong. Love the whole continuum notion of all the different product types, and just that attainable product that's entering the market. And they're kind of quiet, and they're a little sneaky. So, keep your eye open for those different brands to help you get a sense of what's going on in the market. One thing I'm missing, and I'm not addressing it because we just don't know yet, is the distress. And that falls under opportunity a little bit, because there are people out there waiting to pounce on the distress. And I'm talking to people are raising money, people are looking for those opportunities, and we just haven't seen that open up in the market yet. Maybe next time we'll have some data on that. I've looked at the data. There was actually an article in the Wall Street Journal today about apartments being the next shoe to drop after office. And again, they acknowledge in that article that we're just not seeing any movement yet with lenders, with owners, et cetera. So that is to come. The biggest wall of debt was this year, and it looks to be that it's being extended out. We also have 2 more years of pretty high numbers, and then after that it falls off. So if we're looking at extensions that are 18 to 24 months and the market holds up, who knows where that distressed activity will come from, and opportunities that evolve from that. Because we know that there are communities that are in distress based on underwriting that occurred during that peak occupancy and rent growth time period. So that's out there. Wanted to address that and let you know that we're studying it, and there's more to come. Glad to talk to those who are looking for those opportunities.
Excellent job, Kimberly. That was amazing. Love your takeaways. You had a lot of data points here over the past few weeks to pull from, with our job reports last week, or all the Fed rate questions coming up. And as you mentioned, Q2 earnings from the REITs. I think there's some great data points to be pulled out of there that support a lot of what you're saying here in your takeaways. I want to thank everyone for participating. We're short on time, but we do have a chance for some quick questions if you want to throw those into the chat. Kimberly, one question that came up, and I can kind of answer this, but Greg Fanton wanted to get your opinion on the recent comments about some form of federal government price controls on rental housing. My piece of it would be that I know the National Multifamily Housing Council has put forward some great resources about this. They have some fact sheets out there that basically show amongst economists that rent control is probably not the best tactic in order to get a better handle on housing affordability. So I will direct Greg that way. I don't know if you have a take on it, or any opinion on how that might play out.
Rob, you hit the nail on the head. That NMHC is all over that, and is providing the resources and the data to officials, both locally and nationally, to help underscore the need for more supply in order to alleviate the housing shortages and housing crises. So that more to come. But I will also comment that many of my clients really stay out of some of those West Coast markets where there is more risk of that locally. And but there are also local players there that know how to navigate it and work right through it. So there are those that are just going to turn their head away from those markets, and then there are those within the markets that are going to try to solve the problem. So I've seen that kind of play out a little bit on the West Coast.
Excellent. Kimberly, I have another question come in from Luke Salmon regarding attainable housing. And his question is if you have a take on how attainable housing developers are going to be able to make their deals profitable without LIHTC subsidies. If they're within 80 to 120% AMI, shouldn't they qualify?
They are not going after subsidies. They are doing this all on a market based. And the way that they're doing it is more focused on the cost control on the development side and on the site selection side. So it is literally, they've designed a playbook, to use a word in front of us, and they're dropping it down where it makes sense. And it's more of an entitlement issue and less about redesigning every time. So they're looking for cost efficiencies, and they're leaning on their existing staff and all of their know-how and best practices and development to keep those costs down. And also, like I mentioned earlier, they're bigger. So they're spreading the costs over more units. So there's a lot of different ways that they're playing in these markets. A lot of it is, if you look at what submarkets that they're going into, it's places like Rosenberg, Texas. It's not urban Houston. So they're looking for sites where the land costs are much lower. So there's all those different levers that they're pulling, but it's really cost focused and not subsidy focused. So there is no income qualification. It's for anybody that wants to live there. Someone making way over AMI could afford to, if they want to live there, could live there.
Excellent. Well, and I know since you have the MFE conference slide up, you're going to be moderating the attainable housing session, as well as a developer diversification session at the MFE conference at the end of September. So I'd like to invite everybody on the webinar. There's a discount code at the bottom of the screen that you can get an additional amount off your registration. Come see Kimberly in person at the MFE conference. And then finally, I'm sure there was some specific questions that may have come up regarding your local markets. We do have local market snapshots that are available at no charge from any one of the 65 top US CBSAs. You can receive a market snapshot just by scanning that code or indicating in the survey that you're going to get post-webinar. So I'd invite you to take advantage of that resource that Zonda makes available to you and gives you some insight as to our data capabilities. But Kimberly, I want to thank everybody for attending. Thank you for all of your preparation with this webinar. It was outstanding information. And please stay tuned for information on future webinars and future events by Zonda. Thanks for attending.
Thank you, Rob.